Hi everyone, welcome back to another episode of Providence Money Wisdom Podcast. I'm your host, Isaac, Associate Advisor at Provident. Joining with me today is Cheng Chai-sen, who is the head of our investment team at Provident. Hi Chai-sen.
Hi Isaac.
Yeah, so today's topic would be alternative investments. So it's a very interesting topic. And to begin with, let me just ask, what are alternative investments?
Alternative investments are investments that are not your typical public equity and fixed income kind of investments. So they run the gamut of private equity, private credit, infrastructure, real estate, and also natural resources. So all these comprise a very broad category of what is termed alternative investments.
Right. Prior to working at Provident, you have had 7 years of experience at some alternative investment funds. So what can you share about alternative investing from your own experience?
Yeah, my experience prior to Provident was at a hedge fund and also at a private credit fund that was part of a larger private equity group. So it was interesting. I think one of the parts of alternative investing, or at least in the fund space where most people don't see so often, is there's a lot of structuring involved. So what that means is you're not, when you make an investment in public equity or public credit, you run the analysis, get the numbers, you think about what the returns might be, what the upside, downside, the risks are. And then you can, it's just buy, or sell, right? The product is really there for you. But when you want to invest in a company through a private route, you've got to think of, all the other aspects around it about how you actually want to structure your investment into this company. Is it going to be through equity? Is it going to be through debt or a mix of both? And also think about how you exit. So those are some of the, I guess, more interesting parts about working in alternative investment funds.
Right. So what do you think attracts investors when it comes to alternative investing?
I think, of course, one thing that attracts all investors is that for the successful funds, the returns are much higher than the market. Typically, the successful investors will outperform the market, so that's definitely an attraction for investors. Another part is also the lower volatility around some certain types of alternative investing, be it real estate or be it private equity, because these assets are more illiquid and they're not exposed to the daily mark-to-market in the public markets. They have lower volatility, and that can make it more attractive to some investors. And I think the last part about alternatives that makes it quite attractive to bigger institutions especially is that they allow you to scale your investments, because for example, if you are running a $1 trillion fund or hundreds of billions of dollars, it's very hard to invest everything into public markets, because then you would be taking up too big positions in certain companies. There might not be enough companies that you can invest in that makes it scalable or sort of worth your while, because if you invest say 10 million in a company when you're running hundreds of billions of dollars, that's not going to move the needle. Even if that 10 million doubles, it's not going to move your needle at all on your performance. So alternative investments do provide us opportunity for very large funds to invest at scale. And so I think that also makes it quite attractive to certain types of investors.
Right. So let's focus a little more on private equity. So, since Provident has recently taken a look at this asset class, what are the typical types of private equity?
There are two different types of private equity. Two main types are LBO investing, leverage buyout funds, or venture capital funds. So these are the two main types of private equity. The major differences between them are the scale, because they both involve investing in private companies. But one of them, the leverage buyout, is typically much larger companies involving billions of dollars, where a firm would be bought out by the private equity fund, by the leverage buyout fund, and typically part of the financing is through debt, which is why it's called a leverage buyout fund. There's a certain element of leverage. For venture capital, the companies are much smaller. Usually it is startups, can be Series A or B. And so what that means is these are very early stage investors that come in before the company is even profitable usually. Therefore, they can't go public because you have to show a certain amount of profitability for a few years before most exchanges let you go public. So these are investors taking a lot of risk to invest in the very early stages, but then these companies are very small. So a venture capital side, your investment sizes into companies can be 5 million or less.
Right. So let's focus a little more into traditional buyout funds. So you just gave a brief overview about leverage buyout, but can you give our listeners some more insights about the process of buyout investing and what it entails?
Yeah. So I think if you look at the financial news, you would see a lot of companies being bought and sold every day. And leverage buyout funds are pretty much part of this process. So, leverage buyout investing is, like I mentioned earlier, first of all, the investors will take a look at potential companies that they can acquire, use their capital to fund the acquisition. But of course, when they are doing that acquisition process, they are also looking at structuring a certain amount of debt and working with investment banks, usually to raise the debt, which is also then sold on to other investors. And so they will fund part of the acquisition through debt because they feel that the cash flow of this company is strong enough that it can service the debt. And usually the target companies are companies that either have strong brands but operationally have fallen a bit on hard times, or companies that maybe their capital structure is not as efficient. And so where these leverage buyout funds add value is that they both work with the management to improve the capital structure of the company, like maybe they optimize the financing, get better terms at the bank, etc. Or they also help to optimize the operations by bringing in their own management teams. They have many specialists, a specialist network of many different industry experts that they can bring in to help run the companies and then make these companies more efficient, more profitable. And then, of course, their eventual goal is to exit and to sell the company either as a whole to somebody else, or they would list the company and then sell the shares on the public market and then slowly exit their controlling stake over time.
Right. So in a way, they are something like buying a fixer-upper, they fix it up and then they sell it for a higher price.
That's one way to think of it. Yeah, that's one way to think of it. But of course, in a more sophisticated manner.
Right, for sure. Yeah. So how does the fees for private equity funds differ from a typical equity fund then? I suppose it will be higher?
Yeah, a typical equity fund, will charge you, depending on what kind of equity fund. If it's index fund, it might charge you anywhere from 10 to 30 basis points. If it's normal public active managed fund, the fees range from 1% to 1.5%. Most alternative funds and of course LBO funds included. Management fees go from 1 to 2%. And then of course there's a performance fee which is usually around 20%. So that does mean that the fees for investing in alternatives are typically higher than your public equity fund.
Right. So they will have to outperform, a lot more than equity funds to give outsized return, like you mentioned earlier in the podcast, that would really attract investors.
Yes, they would have the big outperformance.
Right. Can you share Providend's view then on private equity using the lens of our investment philosophy?
Yeah, that's a great question. We looked at it recently, looked at the asset class through our investment philosophy. And just to refresh our listeners, Providend's investment philosophy has got 4 pillars. First one is economic theory or rationale, which basically means that any asset class we invest in, there must be some kind of economic basis for their return. For example, if you buy shares in a business, why is there a return? That is because you own part of a business. When the business makes profits, those profits, part of it accrues to you as the shareholder. Then the next one is empirical evidence, and basically what it means is that you must see some evidence that the fund or the asset class is doing what it's supposed to do, i.e. give you good returns over time. Then there's implementation, which is where we are focused on fees, accessibility, where we can add value to our clients by ensuring that we either help them get a most cost-effective solution, or we can help them implement it in a way that's convenient. And lastly, practical considerations, which is basically understanding that every client has different circumstances, is different wants and needs, and so the suitability of the investment for that client must also be there. Because it can be a great investment, gives you very high returns, but it can be extremely volatile. But if the client cannot take that volatility, then that's not going to be the investment for that client.
So how many checkbox does PE funds tick in that case?
Yeah, so I'm just about to get to that. So we looked at it through those lenses. So first of all, from economic rationale, well, definitely there should be a return from investing in private equity, because basically they're buying over companies, especially in the case of LBO. So you become 100% shareholder essentially of this company. And so whatever profits that finally flow down to you, that's your return. So there's definitely some kind of return for on an economic basis for private equity. There's also the fact that these are illiquid, and so you would expect that you would get a slightly higher return because there should be a bit of a premium for illiquid investments. Because if you can buy a liquid investment and an illiquid one, you have a choice of two, and they both give you the same return, you're definitely just going to buy the liquid one, because if you need the money, you can at least get it out more easily than the illiquid one. So to convince a rational investor to buy an illiquid investment, you definitely need to have a higher return. So from an economic rational standpoint, we definitely see that private equity, there should be some kind of expected return there. And then, of course, we looked at the empirical evidence. And of course, private equity does have a certain track record. Of course, the data can be hard to find, but we did look at a few studies. And while, it's inconclusive that overall every private equity fund is going to deliver very good returns, but we do see that private equity firms with a long track record that have successfully run funds before, those funds, the subsequent funds that they run, typically do better than the market. So there is this element of transferring the expertise, the networks that they have built up to continuously generate better returns for their subsequent funds. So, but overall, as an asset class, it can be a bit inconclusive because there are some studies also that show if you were to take just a small mid cap kind of fund and lever it up the same way, you might get similar returns. So it could be the effect of leverage that does bring a lot of those returns. I think where we found it a bit more challenging, was implementation, because of course, as you mentioned earlier, the fees are a lot higher than your typical fund. And I think the more challenging part is getting access to those good funds, because at our scale, the typical client at Provident, you would need to have very high net worth to invest into some of these better, larger, bigger names in private equity. So that posed some challenges there. And then lastly, from a practical consideration standpoint, I think Provident focuses a lot on sufficiency. And so unless there's a true need to take this risk, and you really need this kind of return that you can't even get investing in public markets, it might not be so suitable for the majority of our clients. So from that standpoint, we think it's a very interesting asset class, and we definitely keep our eye on it. We do have ways to access some private equity through our EAM platforms that we have on Provident for higher net worth clients. But we also, keep in mind the implementation and the practical consideration challenges. And so right now, we feel that it's not something we recommend to every single client at Provident, but we, take it on a case-by-case basis for clients that have that might really be interested in this asset class.
So, Chai-Sen, can I say that once we have a discussion with the client and they have high enough net worth and they have interest in this, we are open to implementing this for them. But for most of our clients, simple stock and bond portfolio would suffice.
I think for most people, really holding a diversified portfolio of stocks and bonds is a very sensible way to start your investing journey, and it can definitely help you achieve vast majority of your wealth goals, because of course, if you look at the returns from public equities over time, they have been fairly high over the last 100 years if you look at the US data. We are open to having further discussions with clients around their interest in private equity, but as you know, Provident does have our planning philosophy, which is focused around sufficiency, which we look at the client's need, ability, and willingness to take risk. And if the client truly, is able to and willing to take that risk, definitely is something that we can explore further with the client.
Right. Okay. So thank you so much, Chai-Sen. So that concludes our episode. So to all our listeners, I hope you all enjoyed our episode on alternative investments. If you like this episode, follow our podcast and follow us on social media for similar contents. As always, thank you for listening, and I'll see you in the next episode. All analysis, views or opinions from interviews, recommendations and other information podcasted or published herein are provided for general information purposes only. Information expressed does not take into account any specific situation, particular needs or objectives, and should not be construed as specific advice or a recommendation. Information has been obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed. Always consult with a qualified investment, legal or tax professional before taking any action. Provident Limited does not accept any liability for any loss whatsoever arising from any use of the information broadcasted or published herein. All contents and information contained herein may not be copied or reproduced in whole or in part by any means without prior written consent of Provident Limited.